think a number of interesting developments for 2014. First of all, our view is that global growth is going to accelerate over the next 12 months. So as there's less austerity in Europe and the US, we should see growth rates increase. That leads on to the second point of central bank policies. So it looks likely that the Federal Reserve will start to end its QE policies in 2014, which could have major ramifications for markets. And eventually, as we enter 2015, people will be thinking about when they put up interest rates at some point. Important with regard to that decision as well is whether inflation stays low. Our view is that inflation will stay low. We think that is the most likely scenario. And then finally, the issues that have dogged markets for the last couple of years over whether Chinese growth is sustainable or whether Europe can build on this fragile recovery so far, those are going to be important issues as we enter 2014. Yes, we're quite optimistic about the outlook for the US. We think that growth is going to be sustained at a moderate but steady pace, perhaps in the 2 to 2.5% range. We think that household deleveraging has progressed a long way, that home building is going to pick up over the next 2 years, and also the shale boom has meant that oil production has increased dramatically, and that is a great tailwind for the US economy. Europe was gripped by a financial panic and crisis, as we know, and for 3 years really, that ended ostensibly when Mario Draghi, the president of the ECB, stood up and said that the ECB would do whatever it takes to preserve the euro. Since that point in time, financial markets have been far calmer and bond yields have started to decline, and in the last 6 months the economy overall has started to recover very gradually. Our expectation is that that recovery will continue, but it will remain quite fragile and quite slow, and the big risk there really is politics, but the signs more recently are encouraging, and we're hopeful that Europe can build on these early signs of recovery. Emerging markets were all the rage for a number of years, but the last 2 or 3 years they've underperformed quite significantly the developed markets. Our sense now is that people are far more realistic about emerging markets. The valuations have improved a lot as well. So the outlook going forwards is more positive. Each of the countries that dominate the emerging market sphere have their own issues that they need to deal with, but we're hopeful that going forwards, growth can be sustained and that those markets will provide better returns going forwards. At the moment, we're positive on equities and overweight equities versus any benchmarks in the different funds. We think the global economy is recovering, and we think that valuations are still supportive of equities outperforming fixed income, for example. Within fixed income, we have a preference for corporate bonds still, and again, although the asset class has done very well, we still think valuations are sufficient that corporate bonds should outperform government bonds and cash going forwards. We have a modest weighting in government bonds, and therefore we have a moderate weighting in cash as well. Our expectation is that it will be a challenging period for government bonds going forwards, but I think there are opportunities on a country-by-country basis, and the cash weighting really is there as dry powder for when we see a better opportunity, which we expect in the coming months.